Hi, this is Lex, and welcome to the FinTech Blueprint. It's your podcast about fintech, decentralized finance, digital banking, investing, robo-advice, artificial intelligence, and all the other frontier technology that is transforming financial services. To get more content, like an illustrated transcript of this conversation in your inbox, subscribe at fintechblueprint.com. So without further delay, let's jump into today's episode. Brian, welcome to the FinTech Blueprint.
Thanks for having me.
It's so exciting to chat to you. It's a really fantastic moment in fintech, as it seems to be every week. So for our listeners, Brian is the CEO of M1 Finance, a really compelling, quickly growing digital investing company. And I'm really excited to explore its story and explore how it's different to the other things that are happening in fintech and learn about this next generation offering. So, Brian, maybe we can just start off with a little bit of your background, your journey, and how that led you to the fintech space.
Yeah, absolutely. So probably the most pertinent part of the background is I was just exposed to finance and investing at quite a young age. So parents showed me a brokerage account sort of 10, 11 years old, said, this is investing, you can place a trade, you can invest in a company. And I think their perspective was they wanted me to have exposure. They said, hey, if this interests you at all, you can learn more. If it doesn't, you got to learn the basics. And from a really early age, I was just captivated by the notion of investing. There was sort of this hairy intellectual puzzle out there of what is the company doing, what's it competing against, what's it worth, a qualitative or a quantitative assessment of what is it generating from a revenue perspective, profits and the like, and then you're placing a high conviction bet behind it. And so it was intellectual problem with stakes attached, which just really captivated me from a pretty young age. So did that middle school, high school into college, did undergrad at Stanford, where I majored in econ and math. Did a stint at a hedge fund and a management consulting firm prior to starting M1. And it was really from the young age developing the natural fluency with personal finance and really at the age of 25 saying, these tools that I'm using to manage my money really haven't changed all that much since I was 10, 11 and was first exposed. And thinking that the consumer applications outside of finance had increased in dramatic fashion. Everything got better. And for some reason, inside of finance, they seem to be relatively stagnant, despite it being a massive, fundamental need for people to manage their own finances. And so creating M1 is really the manifestation of the personal finance account I wish existed in the marketplace that didn't. We started with an online investing platform. And so the investing platform is the brokerage account that I wish existed. And we have since migrated to more of a holistic personal finance platform where you can invest, borrow, spend, and really automate any dollar to optimize your personalized financial plan.
So I'm excited to go into the sort of operating part about the company, but I want to kick around a little bit about your personal psychographics and the sort of statement that the investing tools out there, even 3-4 years ago were the same as 15 years ago. And I think that ties very closely to probably how you want to put money to work. So these may sound like silly questions, but do you like trading? Do you like investing? What about it appeals to you?
Yeah, for me and for our user base, it's all about investing, which we differentiate pretty substantially versus trading. Whereas trading, we talk about it as, doesn't really matter what the underlying company is doing or the like. You're just trying to play the price movements and buy it for one price, sell it to another person for a higher price in a short amount of time. And sometimes you're right, sometimes you're wrong. If you're right, you make money. The nice thing is it's short term, and so you can see your results in a short amount of time. Versus investing is really about buying ownership in the underlying company or the underlying asset. And what you're doing is you're taking a stake of all the value that company accrues over long periods of time. And so I think the sort of moniker of are you an investor or are you a trader is sort of the Warren Buffett quote. Would you be okay if you didn't get a price quote or you couldn't sell it for 5 years? If you're fine with that, you're more of an investor. You're buying the underlying asset and you're comfortable with what you own and what it produces over time. I think M1 is much more geared towards that long-term investing mindset, and it's all built around portfolio management rather than stock trading. And so the principle is you should be able to tell a software platform, this is what I want my investment portfolio to look like on a percentage basis. I want 15% allocated to this. I want 20% allocated to that. And anytime you deploy money against it, all your money should be intelligently directed into that custom portfolio. And the nice thing there is it attacks the common use case for an investor where it's, I'm trying to put my money to work for 5, 10, 15, 20 years for my first house, my kids' education, my retirement, but I want it to go into the investments that I know and understand. And that's exactly what M1's built. We've built a free automated brokerage where you can design a custom portfolio. You can customize the portfolio to your heart's content. We have a bunch of templates to get started, sort of similar to the robo-advisor-esque allocations, but you can customize it with any stock or ETF that you want to invest in, all done on a percentage basis, a really intuitive way to construct and organize the portfolio. And then you just deploy money against it and it all goes to work. And we're doing a lot of creative things in the background to make that happen.
Absolutely. So I think the combination of asset allocation with single security selection, with fractional shares, with automated rebalancing and a portfolio management approach, kind of massively customized, is really interesting. I still want to dig into your philosophy, which is, even today, do you think that when you buy a stock, it reflects cash flows in the company and an ownership share, and that investors buy stocks because they understand the companies that they invest in? Like, I've seen the word self-directed on your website, and so is it? Do you hold the belief that an individual can do research and make an investment decision based on information out there? Like, how do you approach why or when somebody should be putting money to work?
Yeah, so in some sense, creating M1 was sort of a reaction to feeling like the world had split in one of two fashions. The one fashion was you need to outsource it completely. You need to hand it to a mutual fund, an advisor, or put it passive in ETFs, and you should have no control. Sort of the moniker of individual investors are not intelligent enough to manage their own money. They should hand it off to experts. Or it's moved into the hyper trading platforms where you should buy at 10 a.m., sell at 10:30. You should do levered options, and you should try to play the earnings call and play momentum, and in some sense just try to be short-term reacted. M1 is sort of the middle ground. It's saying you should be long-term oriented. You should be buying ownership stakes in companies or asset classes. You can buy ETFs that represent an asset class, the S&P 500, whatever it may be, and you should systematically deploy to that portfolio over time. And it is sort of a mix between the two philosophies of, I do think over long periods of time, price has to trend towards value, that you are buying an ownership stake, and over the long periods of time, the ownership stake is going to reflect what the underlying company does, produces, spits off as cash flow, or the like. I think in the short term, as we've seen in the last couple of weeks, anything can happen. There can be short term, everything is driven by short term supply and demand, and if those get out of whack, it can send the price really anywhere. I still think that's a harder game to predict, and I think we encourage a individual to be engaged in their portfolio. That we say it's very hard to succeed at anything if you outsource it completely. If you say, I don't care about it, I'm having someone else manage it, it's really hard to be engaged, participate, and truthfully, the most fundamental thing that leads to a higher net worth is not whether you underperform or outperform the index by 15 basis points. It's whether you contribute 15% of your salary to investments at any given time or 2%. Those are the fundamental things. That being said, I do think trading is on net a losing battle, that it's sort of a zero-sum game between the winners and losers. Even with low transaction fees, you're going to eat the spread every time. It's hyper tax inefficient. People are probably outmatched from an information perspective. And so we are very anti-trading because fundamentally we don't know what something's worth at 10 a.m. versus 10:30 or the random fluctuations that drive that movement. We are very pro engaging with your investment portfolio and buying things that you know and understand, and that leading to positive behavioral outcomes of adding more to your portfolio, systematically contributing to it, and being a little bit more patient as value takes a long time to build and you're not as reactive to short-term noise.
So I think one thing that you guys have done really remarkably is articulate a value proposition to this kind of active-ish in the middle type of investor that is sticky and that's actually meaningful. And I'll just play my cards here, which is to say that the two extremes that you describe are or have been by fintech quite strongly targeted and served, right? So on the one side, the Betterments and Wealthfronts of the world offering a packaged asset allocation that is largely devoid of alpha, but is about that recurring investment. And at best, within that investment philosophy, you would say, 10 or 20% of some pie chart is dedicated to my opportunistic investing, and that's done somewhere else, right? So even though people talked about that opportunistic portfolio, it was never implemented in a nice technology-led way. And then on the other side, you've got the free brokerages and Robinhoods and that model, which really just requires volume, and volume is the cocaine of the financial industry. It's exhilarating, but very bad for your long-term financial health. And I think the common wisdom's the wrong word, but the assumption was that it was really hard to build something in the middle that was able to capture people who wanted to have a say in their investment implementation. They didn't want to take the BlackRock models and just go forward with a 60-40 portfolio, but at the same time did not want to be flying around in the world of derivatives and sort of the astrology of technical chart reading and things of that nature. And I'll bring up, Motif as a company that had tried to do this, and then Kaching, which is the prior incarnation of Wealthfront, which had tried to target this demographic, and they were not able to do it right. It was either social following to try and create trading in that manner, or it was portfolios that you couldn't quite customize, even though they were tilted towards particular themes. And I'd love to hear your view on why your millions of people that are engaging with your services, why you think you've solved this client base and kind of given them something really existential, which comes out in your performance. But I'd love to hear how you think about it.
Yeah. So, with the demographic that we're talking about, the person who says, I'm engaged with my finances, I generally like it, I have a perspective, I'm managing modest to large sums of money, but I don't want to be a professional day trader. I don't need 15 screens up on in front of me with a laptop and drawing crazy charts and lines over it, trying to predict the future. That is actually a quite massive market. That's the same group that watches CNBC, reads Wall Street Journal, goes to Forbes, reads Seeking Alpha, participates on Reddit investing. And so this is a huge, huge market. And traditionally, they have used the self-directed brokerages of Ameritrade, E-Trade, Fidelity, and Schwab. The weird thing about that is all of those brokerage platforms that I just mentioned are fundamentally trading platforms. They base every action around the trade. So it's buy this security, this order type, this amount, click a button, previously get hit with a commission. Now that has gone away, but they make money on the trade. And, I like the phrase that volume is the cocaine of the finance industry. They're just trying to encourage activity. But a lot of those people, what they're trying to do is really build a diversified investment portfolio of things that they know and understand and want to hold for incredibly long periods of time. M1 has just been one of the first brokerages, you mentioned a couple others that didn't get as much traction as we have, that really fundamentally put the user perspective very directly in build your portfolio and automate your portfolio. Tell the software platform, this is what I want to own at any given time, and then just deploy money against it. Don't worry about the manual things of placing trades or how much, or are you overbalanced or underbalanced. Software is just better suited for that. It can do the math a lot easier than a human can with, pen and paper or a calculator. And so it's leave the mundane administrative to the computer to implement, but you set the direction, you set the personalized plan, and we can do it for incredibly low cost, and we offer the service for free. It's very difficult to know why we've succeeded where others have done something tangentially related and failed. Could talk about the nuances and difference. I think if we were to analogize it to another industry, it's sort of like the movie industry and saying, hey, someone created a comic book movie and it failed, and then another person did a comic book movie and it succeeded. And it says nothing about comic book movies, but it fundamentally says, is the movie good? Is it entertaining? Does it provide a compelling user experience? And I think M1 has very purposefully built for a long-term, self-directed investor who has a perspective, who wants to make choices, but then have it be automated by a software platform. And we've branched out and offer other financial service product to create the holistic platform. And I think we've just done it in a more compelling user experience fashion that people who use the product love it, rave about it. We have 28,000 people in our Reddit community who talk about how they use M1, share investment ideas. We have 25,000 plus 5-star ratings on the App Store of people who are using it, enjoying it, loving it. And so I think it's really a combination of the fundamental principle of who we're going after, who we're serving, and delivering the best tool on the market for them, as well as just doing it in a very compelling user experience fashion.
Absolutely. I mean, you are you're the Avengers of the prudent, self-directed investor rather than the Fantastic Four for the same audience. So I totally get it. And
I may steal that,
yeah, no, please. It reminds me a little bit also of when you think about like advisor technology. So financial advisors have a number of different investment philosophies, the same way that individual investors do, from passive allocation all the way through to active management. And there had been a number of advisor-focused tools that help separately managed accounts rebalance or rebalance against models. And in particular, there's a firm called Smartleaf that I had worked with in the past that was doing this really valuable thing of just rebalancing the portfolio and being thoughtful about tax loss harvesting and making it easy. And I think this is part of the general trend of financial products being much more directly held by people that need them and use them. And that the intermediation that we saw, 10 years ago or 20 years ago, where it was, like you said, assumed that you need a financial doctor to bake you the pie chart, that is less and less true. So let's pause a little bit on the offering of the company, right? So we've talked about the pies, the allocations. Can you flesh out a little bit more sort of the full offering and how it fits together and how you see maybe how it came together to be that package?
Yeah, absolutely. So we talking about what you just hit on, we think that in the future, people will be self-directed via a digital platform simply because it offers a massive cost advantage that is quite difficult to replicate on a person-by-person, face-to-face interaction perspective. And it's really a fundamental belief that everybody should be able to use a digital platform, say, this is how I want my money managed or my finances managed across everything that I do with my finances. And then the software intelligently optimizes that personalized plan. So the future is every single person has a personalized financial plan across how they invest, borrow, and spend their money. Software automates it by default. And so all the beneficial behaviors are happening by default. You don't have to consistently remake them, but you have as much control as you want to have in the process, or to tune the dials as you see fit. And so, when we talk about a person's finances, we say they have to manage their own personal balance sheet. So their assets and liabilities or investments and borrowings. And then they have to manage their cash flow, how they spend and receive money. And so M1 has made it a little bit more consumer friendly, where we say it's how you invest, how you borrow, and how you spend your money. And we have a product that attacks each one of those verticals. And our philosophy is to have a best-in-class product across each one of those three verticals, but then have them seamlessly integrated and automated across that so that the whole is greater than the sum of the parts. So we've talked about Invest, that's free automated investing in a custom stock and ETF portfolio. We then added M1 Borrow, which lets you borrow using your portfolio as collateral at incredibly low interest rates. So you can borrow up to 35% of your portfolio's value, your invest portfolio value, at rates as low as 2%. And so the use case there is if you have a $200,000 M1 Invest portfolio, you're going to have a $70,000 line of credit at 2%. And it's always available. You don't have to fill out paperwork to get it. You only pay for what you use. You can pay it back whenever. There's no prepayment risk, and you can use it for whatever. So you can lever your portfolio. You can bring it off platform and use it in lieu of a auto loan or HELOC, or if you want to finance a vacation instead of putting it on 18% credit card debt. And so it's on-demand capital, and it's really saying if you have a liquid investment portfolio, the finance firm in the background should be able to use that to facilitate lower cost credit than you can get anywhere else. We then added M1 Spend, which is an integrated digital checking account. It's everything that you'd expect with a checking account. So you have an account and routing number, so you can direct deposit, you can bill pay, and you get an M1 issued debit card. We have two versions of that. One is a completely free version. The other is paid with an annual fee that gives you 1% interest on your cash balance, as well as 1% cash back through the M1 debit card. That paid version also gives you benefits across invest and borrow. So, it's a best-in-class product within each one of those three verticals of invest, borrow, spend. And then it's really focused on the automation and synergistic effects between those three. And so it's really, replace your checking account, have direct deposit into the account. As your cash balance goes above a threshold that you set, you can sweep it over to your investments. You can first, max out your IRA. Then once you max out your IRA, it can spill over to your taxable account. All your money's invested in the securities you want, in exact proportion to what you want for free. And if you ever need liquidity or your cash balance drops too low, you can tap into a line of credit at the lowest interest rate on the market. And so it's really more digitizing the private bank experience and providing a comprehensive, holistic personal finance platform. And we just started with invest, added borrow, then added spend, just because it's a lot to bite off and chew to create a brokerage, digital lending arm, digital bank, all in a short amount of time.
Well, it's definitely a testament that these strategies are available to do now, right? That you are able to combine and launch as part of a new company fairly rapidly digital banking, digital investing, spending on a pretty rapid time frame. I'm really interested in some of the plumbing of how this comes together. I promise you that our listeners are interested in the plumbing as well. And so I want to kick around a little bit how these products are structured. I think another comment is that the distinction that historically has been in place between these different verticals, certainly from a regulatory perspective, doesn't really exist from a consumer perspective. It's not relevant that this is an investment account and this is a banking account and this is a credit account. From what entity you're using, to put that together, for a normal person, is just your money and where it goes inside of the tech app. And so historical barriers are kind of disintegrating. And I think what you're building out is a really good example of that happening. And if we look at the industry as a whole, you see also many of the B2C fintech brands moving in this direction, right? So SoFi's SPAC documents were very explicit about trying to get out of just the student lending and personal lending business and into wealth and cash accounts and all that. Similarly, most brands, regardless of where they start, try to build the super app. Can you talk a little bit about the adoption part of these different pieces of the app and, the sort of holy grail of cross-sell? Like, which things are leading? Where do you see the most growth? How do you think about the growth? What does success look like?
Yeah, you hit on a lot of great points and agree with everything that you've said. I do think we might take a minor distinction of what we think the finance super app ultimately means, despite a lot of people talking in very similar fashions. And I think we approach it less from a cross-sell perspective, even though ultimately that's what we're doing. But it's historically, we think that's what the banks have done. They've had a checking account, and then they have you as a financial customer. And so they'll try to cross-sell you with a mortgage or an auto loan. And then they will say, hey, we already have a financial relationship. We should also own your investments. Let's go buy a brokerage. We'll rebrand it. But really what that feels like is different products under the same brand umbrella. And it's not like any one of the products get better because you're using one. And so, when we think about it, it's really, how does one enhance the other? And the perfect example of that is our invest borrow dichotomy, where if you invest for free, we can offer you better rates on borrowing than you can get anywhere else in the market. And so it's not necessarily that we ultimately are trying to cross-sell and have more engagement, but we're trying to do it in a fashion where the products enhance one another and it makes sense to aggregate on M1 rather than putting together a bunch of point solutions and having a finance folder in your phone with 15 different apps. And it's really saying, if all of this works together, seamlessly integrated, automated, it's better than what you could ever get with point solutions. And, it's incredibly easy to analogize yourself to the most valuable company in the world, but it's sort of like the Apple ecosystem where each product's in isolation. The iPhone's incredible, the Macs, the laptops are incredible, the earpods are great, Apple Music and TV are great. But it's really when you dive into that ecosystem and say, hey, this is my consumer-facing operating system, is really when the magic happens and everything just seamlessly works together. And it's better than having an Android and an HP because they're not linked and the like. And so M1 really approaches it from that capacity. And so historically, we have started as an investing platform. So that's the only thing that you could do. We then added borrow about 18 months after that. And so, you had two products that you could use and cross out. And we now have spend, which we launched about 7 months ago. And so, the adoption cycle has sort of followed that production deployment cycle, but it's really people are signing up for the M1 platform. And, as we continue to grow and orient, you sign up for one account with M1. We will do the administrative work in the background to set up your brokerage accounts, your IRAs, your checking accounts. We are going to be adding credit cards. We're going to be adding other loan type options. You just use M1 as a whole to manage all of your finances. You say, this is how much I want to spend. This is how I want to automate my budgeting. This is where I want to invest. And we as a finance firm will also underwrite the individual as a person as opposed to for a sort of specific need and just line up lines of credit or loan facilities for them and say, hey, you can borrow this amount against your liquid portfolio at this rate. You can borrow this amount against your house at this rate. You can borrow unsecured at this rate. So just go about life and do what you need to manage your finances in a compelling fashion. And the finance firm sort of like takes on the legal regulatory compliance work to just make it happen so that it feels like it's just there's a team in the background optimizing your finances. It's just happening through a digital platform.
Let's look a little bit at the engine. So looking at your site, you have the holding company, which of course it's a financial entity. And then within the holding company, you've got an SEC registered broker dealer, which is the initial business, M1 Finance LLC. And then you've got a relationship with Lincoln Savings Bank, which is an FDIC member for the spending accounts and the debit card. So let me double click on this, right? So with the broker dealer, who are you custodying with? How did you think about who can support, fractional shares and all this stuff?
Yeah. So the broker dealer, M1 Finance LLC, is that registered FINRA member, and that powers our invest and borrow product. Over time, borrow will expand beyond the portfolio line of credit. And so that will be another entity. But for the user's perspective, shouldn't matter for your audiences, just for information purposes. We are what's called an introducing broker dealer, and we sit on top of Apex as our custodian firm. And so they do the settlement and clearance of trades, and they're where the actual securities are held and custodied. They power a lot of the fintech apps. So SoFi, Stash, Betterment. They used to do Robinhood and Wealthfront, but those companies have left, and Robinhood self-clearing, Wealthfront clears on an omnibus basis. And they allowed a lot of the tech-driven APIs that we needed to facilitate our company and growth. So API-driven account opening, we're signing up anywhere from 10 to 25,000 new brokerage accounts a day. It's impossible to do with a paper-based process. You have to have it be highly automated. They're doing, all the bank verifications, the ACH rails, the booking of trades and statement generation, confirm generation, tax document generation. M1 has built an incredible amount of proprietary technology on top of Apex. And with the portfolio allocations, the fractional share engine, and the like, and it really every customer at M1 can have a personalized portfolio. And a $1,000 deposit could kick off 32 trades of different dollar amounts for different fractional shares. And so M1 is very likely the largest trader of fractional shares in the US. We do anywhere from like 300,000 to 400,000 customer book transactions per day. And so it's a small dollar ticket volumes can generate significant amount of trades. And so, we've built a lot of proprietary technology to be able to process a significant amount of transactions in an incredibly short amount of time.
Yeah, no question about that. Apex was a leader in API driven kind of broker dealer as a service, and doesn't surprise me that you use them. And of course, that you have to build on top of that. Makes sense. I have two sort of sneaky questions, I think, related to this. Left field, just thinking about Robinhood and GameStop and all of our friends at the market makers. In this industry structure, does it mean that payments for order flow are not available because you're using an Apex, and that's why Robinhood went self-clearing, and you're not a counterparty to a market maker, or is that wrong?
No, we do execute through market makers. And I do think that there is, I'm sort of in that weird middle ground. We were talking about the middle ground between the traders and passive investors. I'm also in the middle ground of payment for order flow, that it's not as bad as people think. If anything, it's provide incredible liquidity so that spreads have been compressed over long periods of time. And it's incredibly small per trade. The sort of going rate is about 0.2 cents per share. And so our belief is it's a revenue stream. It increases liquidity in the market. It drives spreads to lower and lower. And so from an overall investor perspective, it's a net positive, and a fundamental belief of, if you care about PFOF as an investor, you're losing the forest through the trees. It is an incredibly small amount of drag on an investment return. So the alternative would be commissions or anything, more expensive. That would be a larger drag. So I think it's sort of the best we have. That being said, it sort of goes to the fundamental. If you're trading significantly, it's a zero-sum game. There are winners and losers, and they even out. But whoever is facilitating that trade is taking a rake every single time. And so the people who facilitate significant amount of trading volumes are typically the people who profit the most out of trading activity. And I think it's more of the dynamics of payment for order flow aren't concerning, but the encouragement to trade incredibly frequently and the encouragement to trade levered options that have significant risks and, with small amounts of notional volume can add incredible amounts of exposure and adds risk to the system. I think that sort of gets lost in the weeds as we talk about payment for order flow as well. And so we're sort of anti-high frequency trading, but not anti-payment for order flow.
It is to some extent the emerging market structure. So two questions on top of that. First is, around the business model and the fact that trading is free on M1, and whether sort of on the trading side of the business or on the investment side of the business, that's the primary revenue stream. And the second question is around the trade windows. So I see that you're implementing the trades in bulk, either once a day for free users or twice a day for premium users. Can you talk a little bit about also that and sort of like how it interacts with the design of the thing?
Yeah, so I'll touch first on the revenue model. So we have the three products: invest, borrow, spend, and then we have a membership fee called M1 Plus that is very similar to an Amazon Prime-esque membership, where it gives you benefits across the entire platform. If you're using M1 to manage most of your finances, it more than pays for itself. And so a lot of our heavier users, 25% or so, are M1 Plus users. We make money on the investment portion. Payment for order flow is a revenue stream. It's our smallest revenue stream. If it went to zero, it wouldn't be that material, especially because we eschew high frequency trading. You can't day trade on the platform. Our volumes are much smaller. We're doing that batch trade window stuff as you talked about. The two more meaningful ones are securities lending. So we can take the securities that our users own on the platform and lend it out. And we're primarily doing that to facilitate short selling. It's very similar to the way banks operate. They take in deposits, they lend that out for loans. And so they might just provide the service for free to get the deposits. Then they're using that deposits to sort of leverage the other side of their business and monetize and be that financial intermediary there. We're doing a very similar thing. And because we own individual securities, it's a revenue stream that's available to us that's not available to the robo-advisors, which own broad-based index ETFs. And then people can hold cash on the M1 Invest platform. So we can monetize that, lend that to banks on an overnight basis to do that loan lending that we just talked about. We then have borrow. We lend at rates between 2 and 3.5%. Our cost of capital is significantly less than that. And so we earn a spread on whatever we're lending at any given time. We then have M1 Spend, where people hold cash balances. And so we can monetize those cash balances, as well as an M1 debit card. And so anytime they swipe that, we make interchange fees, which is a percentage of the transaction volume that goes through the card. And so you add all those together, it becomes pretty meaningful. And so, M1 now has about $3.5 billion on the platform. We've quadrupled over the last 12 months, continuing to grow at a very high rate, and sort of having modest but reasonable revenue streams across all product lines means that we have a robust business model across the entire platform.
It's the dream. It's amazing. It's been amazing to see kind of the discovery of what are now foundational revenue streams for fintechs, right? But we can see companies being built entirely on interchange, which was almost like discovered 5 years ago by Silicon Valley and hadn't been applied at all before, and is such a game changer, both because people need cards, they need to spend. They're not just trying to hold some abstract net worth in collateralized box, but also because there is the available economics from the spending and the flywheel around loyalty and rewards and things of that nature. Is it difficult mechanically to get the interchange? Like how did maybe to reframe the question, when you were looking for a depository partner, how did you end up choosing Lincoln? What kind of things does it provide? Is it, is banking as a service a really competitive field? And maybe if you could talk about the infrastructure on that side of the business.
Yeah, for sure. So on the interchange front, there's two big distinctions between interchange for debit card, which is typically less, and then interchange for credit cards, which is typically more. A lot of that has to do with the risk parameters that on the credit side, they're actually providing credit. That being said, the higher interchange on credit cards is also what facilitates the cash back and rewards that people do love. On the debit card side, there's also two tiers of interchange, and it's much higher for banks that have less than 10 billion in assets, and then it sort of drops off a cliff if you go above 10 billion in assets. And so some of the things that fintechs are doing is partnering with banks that have less than 10 billion in assets and will for a long time, so that they can monetize off the higher interchange rate. It'll be a interesting question of whether that dynamic changes or there's any regulatory pressure on that over long periods of time. For us, choosing the bank was a combination of reasons. One, we did want to go with a bank sub 10 billion to monetize at the higher rate. Not many banks are super pro fintech, and so having some that are open to relationships with fintechs limits it pretty dramatically. And so that cut down the sort of available universe to just a handful of small banks. That handful is growing over time. But then the bank that we ultimately selected, Lincoln Savings Bank, really put a focus on fintech as a distribution channel. And so they power the Acorns card. They have some partnership with Square from the Cash App perspective. They did Moneyline at one point. And so, they were more forward thinking of their legacy business was financing farm equipment in rural Iowa for different farmers. And they potentially not the highest growth rate from a business perspective. And so they sort of saw, hey, there are a lot of companies out there that need access to the banking infrastructure, the regulatory environment, the compliance environment, the general rails and the like. While the tech firm was really strong at engineering and product development, they could basically license their charter and provide the services. And so that was a lot of the rationale of why we went with Lincoln Savings.
Listen, farming's very, very important.
Incredibly important. Yeah.
Really, yeah. Alibaba, I think, in large part, credit to farmers. I'd love your hot take just because I haven't looked at this in detail for a while and I'm curious, your hot take on Green Dot, the Bancorp, and I think it's CRV Charles River or CRB Charles River Bank. Maybe I'm Cross River Bank. When you who was the comp set that you looked at that was kind of reasonable and good, and what were the distinctions that made you go with one over the other?
Yeah, so we looked at all of those. Then there's a handful of other private banks that may not be well known or have a huge retail focused presence that also offer the service to partner with fintechs. There is a little bit of a difference in how M1 approaches the market versus some of our fintech peers, where a lot of our fintech peers view everything in terms of users, whereas M1 really tries to view things in terms of dollars, that we monetize on assets, we monetize on liabilities, we monetize on transaction volume. And so we typically tend to target a little bit more of a sophisticated, more affluent user base. And so I think 80% of the money on the platform is held by people who have more than six figures on the M1 platform. So our bread and butter is 5, 6, low 7-figure accounts, whereas a lot of the other fintech players are going after the unbanked, the underbanked, people who are might have $500 in their checking account and sort of hover between negative and 2,000. For us, the difference that leads to is we really tried to monetize the dollars on the platform or the transaction volume as opposed to the user themselves. And I think we are comfortable sort of saying, what do we charge as a percent of total assets on the platform? And it's a relatively small amount. And we think our customers benefit significantly more than the fees that we make on the back end. We do have some concern over those that sort of prioritize charging the user, and they nickel and dime and potentially charge more than the value that they're providing, especially if you sort of did what do they earn from a revenue perspective divided by the amount of assets that they manage. It's a very tricky conundrum because it's sort of a similar thing of what are the other alternatives. But I think for our perspective, we wanted to have a partner that was much more aligned with let's survey our user base incredibly well, take a very small amount of that on serving them, and not have it be perverse incentives of trying to charge people who can likely least afford it.
Cool. Thank you for exploring how the jigsaw puzzle fits together. I think to me, it's one of the the most interesting questions, because the financials and the adoption path of the product is a function of what it is that you put together, of the car that you put together. And I think, again, it just bears repeating that bringing these offerings together and painting a holistic financial picture that is largely automated and is aligned with how people think about their money is really core. And it was pretty prohibitive to do this in the past, and it is available now. And I think that's one of the reasons why you've been able to unlock this customer segment in a way that just didn't happen despite folks taking attempts at it, but now it can. If you think about the future and you think about the company over the next kind of 3-4 years, where are you trying to get to? What's your North Star? And then as part of that, what do you worry about in getting to that North Star?
Yeah, so we 3-4 years, it's going to be continued product development, continued growth of the user base, just continuing to add much more value to the personalized financial automation platform, really digitizing the private bank experience. M1 really has a longer term perspective, and we talk about it as trying to be similar to what Charles Schwab did to Morgan Stanley or Merrill Lynch. That Morgan Stanley, Merrill Lynch, giant incumbent institutions managing hundreds of billions, if not trillions of dollars. And then Schwab came around in the 60s, 70s, and 80s and said, we can deliver better product, better pricing, more digitally and tech-driven focus. And it's not like Morgan Stanley and Merrill Lynch went away. Some got acquired and merged with Bank of America. But Morgan Stanley's still a $100 billion plus company. It's just Charles Schwab is also a $100 billion plus company. We think that there is a huge opportunity to create the next generation financial institution using 2020 technology and really incorporating all the best practices from a consumer experience perspective, from a product perspective, having it be self-driven and automated and using software to automate and power that. And so, when we think about 10, 15, 20 years out, it's really, we do want to be a category defining company that is on the same scale as what Schwab is now. And it's, Schwab, their average customer might be 55, 60 years old. They have a lot of growth to do if they just retain their customers for long periods of time. It's just, we think we can be that company for a next generation of investors. And so, we think we appeal to the same mindset and philosophy as the Schwab investor. We just have modernized it and are doing it to a younger user base. It's sort of the Schwab customer that they got in the 70s. We're just doing it in the 2020 version.
Awesome. Thank you for both the vision and walking through your views on the industry. I think I usually try to argue with people I talk to, but we're aligned on a lot of things. I think one of the things where I've been spending a lot of time thinking is around the manufacturing of financial products and what it means to have cash, or what it means to have financial instruments or stocks or bonds and so on. And so there's a whole blockchain conversation, crypto access conversation that is available to us that maybe we should have another time. But I think that'll conclude our episode for today. Where should our listeners go to find you and learn more?
Yeah, so our website is m1finance.com. And then we have native apps in both app stores, the Apple App Store and Google Play Store. You can type in M1 or M1 Finance. We also are available on all the social channels.
Cool. Brian, thanks so much for joining us.
Yeah, thanks for having me. It was a blast.
Hi, everyone. That's it for this week's episode of the FinTech Blueprint. For more technical deep dives into all things fintech and decentralized finance, check out fintechblueprint.com and grab a free subscription to the newsletter. This is Lex, and I'll see you next time.